Hello traders, and welcome to the third video of the second section within the IPDATrader's private mentorship course. And in this particular section, you should already know that we talk about points of interest, and what we're going to be talking about in this particular video is all the different points of interest that you will need to learn and recognize, right? We're finally going to be moving on and talking about the different points of interest that you will need to learn. Now, the way that I've structured this section is in a way where everything should be really very clear to you once you're actually done with all the videos. So do not stress about the idea that you may not understand what's happening over here. That's going to be how your charts are also going to look like once you understand the way we trade and the way we execute positions. But for now, we're going to be talking about the different types of structure. And in the next POI video, which is essentially, I believe, going to be the last one, we're going to be talking about high volume mitigations, and I'm going to be giving you rules, specific rules that you can follow and that you can use to select your POIs, right? Because I know you've got all these time frames, right? And it can get very confusing when looking through all the time frames, because one time frame may be telling you one thing, the other time frame is going to be telling you a different thing. So that's why in the last video of this section, you're going to learn about different rules that you can start applying today, so that you know which POIs work and which ones do not work. But that's for the fourth video. For now, and in this video, we're going to be watching and taking a look into the different types of points of interest that you will need to learn to recognize in your charts. So with all that presentation out of the way, let's actually move to the drawing board and let's get started. So traders, as I just explained to you, we're going to be finally taking a look into the different types of points of interest. So let's get started, right? This is what we're going to be discussing today. Different types of points of interest. This is the topic for now. So let me start by actually listing all of those, right? You're going to see a couple names here that you may not recognize, but do not worry, it's going to be easy for you to understand. So we have bullish and bearish order blocks, which you already understand and know, which include OB 2.0s, or also known as last points of true mitigations. Right? This thing you already understand and know, so we're not going to be focusing on this. However, guys, there's more to it, right? We also have breaker blocks. We have IFC candles, which stands for institutional funded candles, and we have FU candles, also known as liquidity voids. So this one, the first one, you already should understand it pretty well, so we're going to be straight diving into the other ones, right? Let me move this over here. Let me actually get rid of this one, because this one you already understand, and let's actually start with the breaker blocks. So we're actually going to start with an example here, because it's going to serve you very well in your understanding. So we have a market that is pushing down like this, and all of a sudden you get something like this. Okay, so let's try to think about this structure logically, right? With your understanding about smart money and how price delivers, you should now understand that smart money is selling, 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 selling over here, is buying, buying, buying over here, selling, 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 buying, 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 so on and so forth, right? This should be in the back of your head at this point. You should understand that, hey, the people that are manipulating this market are selling at these prices and are buying it quickly, making a retracement to continue selling at better prices over here, right? So if we look at that, and if I were to delete this particular arrow up and maybe get rid of some of the drawings over here, whoops, do not worry, I'll fix this in a second, just like that. So if I were to give you a retracement leg, where should it stop for smart money to still have the interest in selling and continuing lower, right? If we're in a high volume time, and if I were to give you a retracement leg, where should it technically stop for it to maintain its bearish nature? Well, if you paid attention and you are following with the stuff properly, you should understand that the leg can stop anywhere inside this impulsive move down, as long as we don't break above this high, we're still valid for sells. And if we look at this logically, you should also understand that, hey, this right here is actually a, let me grab this. This is a up move before a down move that leads into a break in market structure. That means that I'm going to have a order block, a bearish order block sitting somewhere in this region right here. So you could say to yourself that if I want a retracement leg, it's going to stop anywhere inside this region, and then it's probably going to continue down, right? If that's what we're going to be doing. Well, this is actually where the breaker comes into play, right? So let me get rid of this particular arrow. Let me keep the bearish order block that you could potentially have at this area. If price did something like this, right, very impulsively, leaving a ton of imbalance on the way up, this is now known as your breaker block. This your previous bearish order block that should have stopped price from continuing up, right, becomes your breaker block, also known as flip zone, right? So let's actually say something like this equals flip zone. So your previous bearish order block becomes your breaker. And do not worry, we're going to be jumping back into the charts in a second to show them to you, but this is something that you want to write down and understand. Your previous bearish block that should have stopped price from pushing higher becomes your breaker slash flip zone, right? And in order for your breaker to be successful, it really needs to have imbalances starting here and ending here, right? It doesn't matter if it has no imbalances over here or over here. The important thing is that for your breaker to be valid, you need to have imbalances in that area, from starting from your bearish order block top to your bearish order block low. This is where you want to see imbalance over here as price breaks through the breaker. So if you see that price impulsively broke structure and went further up, you can expect your breaker to hold, right? It needs to really have expanded a lot in regards and in relation to your structure point for your breaker to be valid, and it also needs to have imbalance within your bearish previous bearish order block. So what you could expect at this point, right? Because with your understanding right now, you could say to yourself, okay, we've created a bullish order block over here. I'm going to wait for that. However, price can very well hit the breaker over here, the flip zone, and continue higher, right? And it may have not hit any order block in particular, and you're left wondering, well, I was expecting price to come all the way down here. Where did it react, right? What did it hit that made it change direction again? And your answer for that is going to be your breaker block, because the previous bearish order block that was supposed to stop price from continuing pushing higher and making it pushing back lower becomes your breaker as price breaks through that zone with strength, right? You need to see momentum up, and you need to have this imbalance characteristic starting from the top of your bearish order block to the bottom of your bearish order block. So that should be pretty understandable for you guys at this point. And let me actually draw a scenario for a bearish breaker block, right? Because you should understand that this is now my bullish breaker block. And let's actually write it over here. Bullish breaker block. You should understand that this previous bearish order block, once price breaks through it with momentum, again, it needs the characteristic of imbalance as it breaks, becomes now your bullish breaker block. Let's now take a look at a potential bearish breaker block, right? Which is going to be easy for you to understand because it's essentially the same thing, just flip the other way around, right? That's the beauty of the markets and the content that you're learning. Once you understand it one way, you can easily understand it the other way around. So let's say we have a market pushing up, and all of a sudden you get a move like that. Well, you understand, smart money is buying and selling over here. They're buying more than they're selling. So price is pushing up, right? That's in the back of your head. And you may have had a bullish order block over here, expecting price to hit it and continue higher. However, that didn't happen and you got an actual break in market structure. Great. If I were to give you, let me get rid of this arrow. If I were to give you a leg down for price to continue higher, you should tell me that it needs to stop anywhere inside this impulsive move up and then should continue, right? It shouldn't get below that. Well, once that happens, well, your bullish order block that you may have been waiting for in order to take buys becomes your bearish breaker block, right? And what you can expect now is as price, let's actually draw it more impulsively, as price breaks through it, this is going to act as a POI I want to watch. Your previous bullish block now becomes your bearish breaker block. Okay, that's the explanation right there. I really tried to make it as clear as possible. I think I've done a good job here, so please take the time to rewind the video if needed, but that's the explanation for breaker blocks. Essentially, they become flip zones, and we're going to be taking a look into the charts very soon so I can illustrate that idea, right? But you should understand now that this previous bullish block, which you were waiting for to continue higher because it made perfect sense, right? We're overall pushing up, becomes your bearish block. As we break below it with strength and impulse, you can expect that price can return over there and then continue lower, right? This doesn't mean that price cannot continue higher, maybe chase some higher order block over here and drop. It just means that once you have the characteristic of a, let me get rid of this, if you have the imbalance in between your bullish block, right, as price breaks impulsively down over here, if it leaves it in balance during this particular price area, then you can expect your bearish, in this case, your bearish breaker block to hold. Okay, you wait for it to come back and you can watch this area. This is a valid POI right here because you have a bearish breaker block that was confirmed with the break in market structure and that has imbalances and strength as it breaks. So guys, that was all the technical explanation there is to the breakers. Now we're going to jump into the charts and we're going to try to identify them and spot them, right? But I want to make one thing very clear, and that is that you don't need to stress about breaker blocks. They do not happen very often. It's just something that it's nice to know and sometimes useful when you see that price is breaking with strong impulse and you know that you're probably not going to get a deep retracement into higher discount prices to then take the sells, right? It's just nice to have in regards to the tools that you can use to trade the markets. And another thing is that the characteristic of the imbalance in between here and here is not absolutely necessary. It's just something that's going to give you a little bit extra confidence and confluence within your breaker. It's not a rule that says if it does not have it, it's not a valid breaker, right? It's just something that I wanted to share with you based on personal experience and in my personal trading, right? It's something that I would want to see if I'm trying to trade a breaker. So that was the technical explanation, and let's move into the charts very quickly. And I've selected a couple of examples over here so that you can take a look, right? Let's start with the one to the left. So as we can see, right, if price was to continue down over here, it should have hit this block and continued lower, hence why this is a valid bearish order block. Now once we break above it, and you can see big candles on the way up, one here, another one here, 3 over here. Now you understand that we have momentum and that this breaker may get respected as we move down, right? And as you can see, if we drag it across over here, we hit the block right here, we hit the breaker and it provides you good reactions up, right? Let's see how much this is in regards to pip. This is a 45 pip move and potentially higher if you held your position over here, right? Potentially 50. So that would be an example of a bullish breaker block. As you can see, we're just applying the theory that we just learned. You see that if price was to continue down in this sort of structure play over here, right, it would have need to hit this block and drop. But that never happened. Matter of fact, price broke through that block, and now you can expect that as price retraces, that breaker block is going to be something you want to watch. That doesn't mean that you cannot have a bearish, a regular order block over here that you want to watch, right? Maybe with a refinement of some area in here. That is also fine. It's just an extra tool for you to frame POIs, okay? Let's now look into the breaker, the other type of breaker. And again, we see it here even better, right? We have a bullish, we have a bearish order block over here, and if price was to continue down, it should have come here and dropped. However, that never happened. Actually, price broke above with a strong candle. That means you can actually see the nature of the candles, how really weak and low volume they are as we're retracing, hence why we hit the breaker over here, right? And we get reactions higher. It doesn't mean it's going to provide you new highs. For that, you should assess structure, liquidity, and time, but it really is a POI and something you want to watch out for, right? You could use, and again, this applies to breakers too, right? Just like we were discussing about order blocks, you can use this over here, you can refine it to this one over here, you can even use this over here, or you can use this entire region over here, right? It's completely up to you and independent. So that was two examples for bullish. Let's now look for a bearish breaker. Same thing, guys. We're not going to be taking too much time here, right? We see the same thing occurring. You may have had, let me actually get rid of this. You may have had a bullish order block over here, right? Because this is a bullish order block right here. And as we break below it with strong candle, right? As we break, we then start getting compression, which is essentially the lows between the distance between the lows have been decreasing, and you get a trade back into the breaker. We never break above the breaker, and we continue higher. And you are probably going to be, maybe you have the situation where you were waiting for this bearish order block, and there's nothing wrong with that, right? You can use both. You can use the breaker, you can use your bearish order block. That is completely up to you, right? Me personally, I would be watching both. But yeah, that's the idea of the breakers, and we're now going to be going back to the charts because we got more types of points of interest to talk about. So guys, the next POI selection we're going to be talking about is clearly the IFC candle, institutional funded candles, right? And do not get confused, it's really the same thing, just with little variables. That's all it is. And I'm really not going to be sort of explaining this particular point of interest because there's nothing to explain. It's just a different type of order block. Some people say they're more powerful, they're more precise. In my experience, they're just the same thing. So let's quickly go back over here and let's look for institutional funded or institutional funded candles, which is right here. This is a institutional funded candle. As you can see, it is not technically a down candle before an up move, but it is sort of a doji looking candle, right? That has imbalances, and that really is all there is to it, right? It's like an order block, but looking like a doji, and it doesn't really need to be the opposite color of the order block, right? So if this was to be a bullish order block, it should have been a bearish candle into a bullish candle. However, this time it is a bullish candle followed by a bullish candle, and that is a IFC structure, institutional funded candles, right? So let's look for more examples because one may not be enough. Let's see what we can find over here. Let me actually zoom in because they're kind of hard to see. And I'm not trying to look for the ones that work. I'm just giving you the examples, okay? This right here is a bullish order block, but it's also a IFC structure at the same time, institutional funded candle. So you can see there's some little mitigation occurring over here, right? Maybe on a lower time frame, you can see some mitigations. Hopefully I can go that fall back. That was not the example. No, this one. You can see we get some bullish price action, very minimal and little, but there's some mitigation occurring here because this is actually another structure. Let's continue looking for more IFC candles. Right here, this is current price action. This this candle right here is a IFC candle, right? We can recognize it because it's a dodgy looking candle. It really doesn't matter if it's going to be black or blue, meaning bullish or bearish, as long as it has that characteristic of it looking like a minimal doji candle with the imbalance over here. You can presume this is a institutional funded candle, hence a point of interest you may want to be watching, right? But the key idea here is that it doesn't matter that it's not the opposite color of the order block, right? So let's try to find one more example. Let me try find an example where the color actually matches. So let's see over here. I don't have much. Maybe we can look into this. Yes, this is a AFC structure right here. Even though, right, even though the color of the candle is technically blue, it's absolutely blue, but it has the characteristics of a IFC structure. It's just like an order block, but what you can understand now is that a order block doesn't always need to have different colors, meaning it doesn't exactly need to be a bearish candle followed by a bullish candle. It can be a bullish candle followed by another bullish candle, and that could be your doji looking candle followed by your high volume candle, and that is also a point of interest you want to watch, known as the IFC. And let's try to find one last example over here. Maybe we can see it better on the 1 minute. This is a great example because this is something you would not be looking at as a POI right here, right? We can see this is actually an IFC candle right here. Okay, it's not difficult to see. We have the bullish candle followed by the bullish candle, momentum up, and we have the doji sort of looking candle at a order block, right? It's like a refinement within an order block, right? So let's do that. Let me actually go to a slightly higher. This right here, this bearish order block, right? Just as we've been sort of teaching in this section, this is a valid bearish order block. Let's actually zoom in and try to find a IFC structure within that bearish order block. Hopefully I can go that far back, please. No, maybe 30-minute. Oh, it's over here actually. Okay, let's see if we can find it, right? It's not 100% guarantee you're gonna find it, but let's actually try to find it. This right here would be an IFC candle. Again, this IFC is mitigated, same rule applies. It's not going to be as high probability, but it's an IFC candle. Same goes with this one right here. This is also an institutional funded candle right here. And as you can see, you always want to keep the wicks included. So that was the entire explanation regarding institutional funded candles, right? I'm not sort of doing any drawing explanation because there's no need for it. You should understand that institutional funded candles are like order blocks, but with doji candles, and they don't need to be the opposite color for it to be considered a valid IFC, right? It doesn't really matter the color of the candle. For example, this right here is a perfect example of an IFC candle right here, right? Even though it fails, right? I'm not telling you it's going to work 100% of the time, but I'm just trying to illustrate you what an IFC candle is, which is exactly this. You see the bearish candle followed by a huge bearish candle with imbalances over here, and that's going to be a order block on a lower time frame, most probably, right? But this just allows you the flexibility to not only include order blocks that are, for example, bullish candle and then a bearish candle, or bearish candle, right? And bullish candle. No, it's not necessary. We have IFCs, which are essentially that, right? You could have a bearish candle over here, and then you could have a bullish candle over here, followed by another bullish candle over here. Oh my god, that was so bad. Let me try again. Right, followed by another bullish candle, and this is your IFC structure. It's not necessary for it to have a bearish candle, right? So that's that. And let's now actually go back and move on to the FU candle voids. These are actually important, and this is my favorite type of point of interest. So let's dive right into that. The reason why I really say that the FU candles are my favorite POIs is because they really show the most aggression in regards to liquidity grab, and really aggressively illustrate what is happening and how people are getting manipulated in the market. So we're going to be diving right back, and let's remove all this stuff, and let me, for this example, actually use candles, because it's going to be much better for your understanding this time. So we can see we have a market that is absolutely coming down, and all of a sudden, right, you get something like this. An absolute fast and quick reversal, right? That could potentially look something like this. And your FU candle, and let me write that down. Let's not use green. FU candle, or liquidity void, is this particular section right here. Let's choose blue. And do not worry, we're going to be jumping back into the charts to show them. This right here is known as your FU candle slash void. This actually shows you the aggression, and you usually see it happen very quick, where it is initially a super bearish candle like this, right? At the time, this may have been looking something like this, maybe with a tiny wick on top, and all of a sudden price starts pulling back, leaving that huge wick, and ends up closing in the opposite direction strongly, but it leaves behind what is known as a FU candle void. And this is where liquidity has been grabbed, and it happened very fast, and for that reason is why you get that sharp and quick reversal right here. So that is really all there is for the FU candles. There's not much theory to it. I mean, I would add that the algorithm is going to be mainly magnetized towards the 50% of the FU candle or more, right? This, from this lower boundary to the midline, is going to be where the algorithm is likely to tap into, right? However, I would, and I'm saying this very honestly, I would still choose the entire POI, right? Meaning the entire wick. The bigger the wick, the bigger the move, probably in the opposite direction, and that really means that tons of sell orders were taken at this point, right? Because in order to make this move happen, they first have to sell very hard. So that means that we can very well expect mitigation back down here whenever that happens, right? It could potentially engineer whatever, double bottom, triple bottom, equal lows, and then grab it into that. Or it could be engineering it on the way down in the form of trendline liquidity, and then smashing it back down into the FU candle void, and then you would look for your confirmation. But whatever, I'm just that's a topic for a different video, right? For now, focus on the FU candle. That looks like this. It's essentially the big wick, and you want to be paying attention to the 50% and the lower boundary. However, still include the upper boundary for bullish FU candles. Now, even though it's pretty self-explanatory, let's actually go ahead and draw this scenario, the opposite scenario, right? So we grab this tool, we draw a market that is clearly pushing up like that, and all of a sudden you get this huge wick that was left behind, and we aggressively start moving in the opposite direction, just like this. Well, this is going to be your FU candle, POI right here, the wick. And you want to pay attention to the 50% because what you will find is that sometimes, and this really happens if you practice, you will find how precisely we sometimes really just hit the 50% of the FU candle and really melt. And this is showing essentially a very liquid reaction to another POI most probably, but that's going to be the next video, not for this one. So keep that in mind. That's your FU candle void, and we're going to be writing that down. FU candle, also known as liquidity voids. There we go. Let's go back to the charts and let's see if we can find some. Again, I don't have any particular scenario prepared, but they really stick out to the eye and you're going to be able to find them. Let's see what we have. Again, this market is kind of compressing over there, but here we have a good example of a FU candle right here. You would use the entire region, which is essentially going to be a something like this in a lower time frame that leaves that huge wick, and you want to denote the 50%. You can use the fit tool, for example. Let's draw it from the top to the bottom right there, and you have your 50% because that's where the algorithm is most likely to target, right? Let's look for more examples. Here we have one more. We can see same thing, huge wick and move in the opposite direction. Here we have one. However, you should never trade them just like, oh, I see one, I'm buying, I'm selling. No, it doesn't work that way, right? You need to really partner those ideas with other things. Over here, for example, we had another one. Just the wick itself, right? There's no need for you to include the candle. Here we have another one. And we see how price precisely trades into that, and we get some sort of mitigation plays, right? We potentially shift structure on a lower time frame, and we continue lower. So those are going to be powerful POIs for you to watch out for. So that was it for this video, guys. Remember to take notes and to actually be looking at your charts, trying to spot for those FU candles and for whatever you want to practice, because the only way your eye is going to get used to and really good at spotting whatever you need to spot is going to be by practicing it. So I see you guys in the next video where we are going to continue talking about points of interest, but a particular different topic. See you guys then.